Good morning or good afternoon, everyone, depending on what part of the world you're in. I'm Dave Chittister, and I'm the CFO of Craftsman Unity, and we are a search fund company, just like many of you are involved in, and look forward to sharing our journey so far with you and how we can help everyone get the most out of these programs from the government. Thank you.
And I'm Hal Mote. Dave and I work together in Craftsman Unity. I'm interim CEO there, been a search fund investor for 25 years, and really excited to be a part of this today to share with you our learnings about the employee retention credit. I'm going to jump into the introduction, and before I hand it back to Sarah to go over the rules, just a brief introduction here. If you think back to April of 2020 and the Paycheck Protection Program, the PPP loan, the FERC is another government program like the PPP. Both give money to small businesses to promote employment, very specific actions on Congress's part to try to keep employment up during the pandemic. And just like the PPP with the ERC, the rules have evolved and changed due to new developments in legislation, the regulations, and professionals' interpretation. We've had a lot of different interpretations. Dave and I have talked to half dozen different firms and gotten very different reads. And so just like the PPP loan in April of 2020, the ERC is somewhat similar to that. Could you go to the next slide, please, April? There are some essential differences, though. The PPP was administered through banks and overseen by the SBA. The pandemic alone triggered eligibility, with that primary driver of eligibility being revenues. Next slide, please. Here's the difference. The ERC, there's no intermediary such as banks. You just file for a tax credit with the IRS. Enforcement's going to be through IRS audits. The IRS has issued, the Department of the Treasury has issued some FAQs and some sort of case type information. In the case of the PPP, in case of FERC, the government response to the pandemic triggers eligibility. And the government response, the government's restrictions must directly affect your company. Also want to point out that the professional opinions are still in the process of converging. Sarah might mention this later in her presentation. She has helped us speak with different groups and bringing these ideas together and trying to get professional opinions to settle in. Here in the ERC, another key difference is there's an or for two sets of eligibility criteria. Either you can have a revenue decline of 50% versus 2019 or 20% versus 2020 for 2021, or the facts and circumstances of partial shutdowns of your company. Even if you didn't have a revenue decline of 20%, you can still qualify. And this is going to be where you may, as a CEO of a search fund company or as an investor in a search fund company, you take a preliminary read of the ERC rules and you say, hey, we don't qualify. This is what Dave and I did. We thought we didn't qualify. Then we started diving in and digging in deeper, and we decided, yes, indeed, we do qualify. But it's a more complicated qualification process, and that's what we're going to try to shed light on today. So let's turn it over to Sarah, and we'll go into her presentation of the rules. Dave will then show how Craftsman Unity, how he has calculated Craftsman's credits, and then I'll share our justification. Then we'll have question and answer. So without further ado, Sarah, take it away.
Thank you, I appreciate it. Next slide, please. So the employee retention credit, this is a fully refundable tax credit that is really overlooked by a lot of people, especially when they hear the word tax, right? Everyone's a little bit scared of taxes. And so by the end of this presentation, what I'd like for you to have a better idea of is whether or not your company is leaving money on the table by dismissing this credit. The Treasury Department has put out a bulletin of sorts, and at the top of it, it says, "Get paid back for keeping employees." And I think that that's a great way of putting it. This credit is fully refundable. And so what that means is that if the credit is larger than the actual tax you owe, the government pays you the difference. This credit is applied against the employer's share of certain payroll taxes, and it varies 2020 versus 2021. It shifts from initially being against Social Security and then later switches to Medicare. Next, please. So I do not want to focus on all the details of the credit. I think that most of us have a basic understanding that there's a credit available. In 2020, it is $5,000 per employee for the entire year. In 2021, it's up to $28,000 per employee for the entire year. As you'll see, the slide provides sort of a breakdown for you. The 2021 amounts it's based on a per quarter calculation of up to 10% of qualified wages. So, one caveat is that large employers are not able to count all wages. They can only count wages paid to employees during the time that they're not providing services. In 2020, a large employer is one that averaged more than 100 full-time employees in 2019. But in 2021, that number goes up to 500, and that allows many, many more businesses to claim the credit for more employees, as you'll see when Hal and Dave talk a little bit more about their specifics. Next, please. So in order to qualify, the employer must have experienced a suspension of their business operations, either a full or partial shutdown due to a government order. Alternatively, there's a significant decline in gross receipts test. In 2020, the amounts are set forth there for you, and in 2021, the amounts are set forth on the other side. I'm not focusing heavily on the details of full shutdowns or significant declines in gross receipts. I call these the bright line tests. It's more self-explanatory. You know if your operations fully ceased because of a government order, and hopefully you can, or your accountants can help you calculate whether or not you've had a decline in gross receipts. So what I'd like to focus on is the slightly more ambiguous test, which is the partial shutdown. Next, please. So a partial shutdown, it must be based on a government order similar to the full shutdown. The key here is that it must be an order, so a proclamation, decree, or order. It cannot be an encouragement or suggestion. When it comes to a partial shutdown, the IRS has made it very clear the shutdown has to have more than a nominal impact on the operations of the business. So the keys here are that we need a government order. It has to limit commerce, travel, and group meetings. It must relate to the suspension of your business, and it has to have more than a nominal impact on your operations under all the facts and circumstances. Next, please. So for businesses that are deemed essential, they are still able to have a partial shutdown. The IRS measures this based on whether or not they have more than a nominal portion of their business operations that are suspended. And you can see here they do provide a gross receipts test as well as an hours of services performed. And so if the gross receipts or hours of services performed represents 10% or more of the total for the business based on the 2019 numbers, then more than a nominal portion of the business of an essential business was suspended. Next, please. So the partial shutdown, you've heard Hal say this, you've heard me say this. It's a facts and circumstance test. The IRS looks to whether or not, under the facts and circumstances, more than a nominal effect on the operations of the business resulted. And again, it's due to a government order that limits commerce, travel, or group meetings. The IRS views an indirect order different depending on certain situations. An example is suppliers. If you're unable to obtain critical goods or materials because of a shutdown order affecting your supplier, even if it doesn't affect you, but therefore without your goods or materials, you have to suspend your operations, that does qualify in their view as a partial shutdown. For customers, however, they don't view it the same way. If your business suspends operations simply because there's a lack of demand and because customers are under a stay-at-home order, they don't view that as qualifying as a partial shutdown. A couple of other facts and circumstances that are really relevant to today's world is the telework, ability to telework. The IRS does not view an entity as having a shutdown if the employees are able to telework, but it could have a partial shutdown depending on the capability of the work to be done remotely, the portability of the work, the need for physical presence. So they look at, is it critical to the business? Is it beneficial but not necessary, or is it just simply convenient and preferred by the employer? Last but not least, they do also specifically address transitioning periods. It is expected in their view that there is going to be a transitioning period if your business was not historically working remotely or did not have telework capabilities. But if it is able to, with a brief transition period, then that does not count as a partial suspension. But if there's a significant delay, I know that there were shortages on, of all sorts of computers and other items, then if that delay is significant, that can qualify as a partial suspension. Similarly, modifications to operations, once again, it's under the facts and circumstances, the modification to your business due to this, government order has to have more than a nominal effect on operations. And so some of the examples they give are, pretty obvious, but they are, I think, helpful. They refer to a restaurant. If a restaurant were under a shutdown order, has to suspend, in-person dining, but they offer, delivery and takeout, that's a partial suspension, even though they're not, fully shut down. Similarly, as there's a transition to fully opening, if there's a period where you're only allowed to have outside dining or limited capacity inside, or even curfew, so that you can only operate for a much shorter period of time. Those are all facts that do get added into this analysis. Finally, multiple locations. This is a big one as well, I think, for a lot of the businesses that I've spoken to in the last year and 10 months. If there are multiple locations and one or two of them are subject to a government order requiring a shutdown, but the remaining of them are not, you may have seen this if compare New York to Alabama. Your New York location may have had a shutdown order, but your Alabama location did not. But the IRS does allow you to view it as an entirety, and so you would have had a partial shutdown. The next slide, please. So documentation, and this has been a topic of much discussion for Hal and Dave and myself. And the IRS does require you to compile and then maintain documentation supporting your position and your credit. So things like government orders, they want you to keep those documentation or that documentation, excuse me. Records are relied on to determine, if there's more than a nominal portion of your business or operations that are suspended. Whether that's financial statements or records, something to that is a record to substantiate, as well as obviously amounts paid to employees. They want to know where those wages were going, who they were paid to, for what purposes. And a key here too is, you cannot double dip with the PPP loan. So you have to have, if you received a PPP loan, you need to be able to substantiate, the wages you used for, calculating your forgiveness, and then show that those are separate from the wages you're using to calculate the employee retention credit. A couple of questions came through before the presentation, but after I created my slides, and so I would like to just address two additional items. And the one is that if you are subject to a government order during a quarter, and then in the middle of the quarter, the order's lifted, then you still qualify for the credit, and you can still count wages during that time up to the date when the order is lifted. And so, you would maybe only have a portion of the quarter's wages that you're using, but it's still available. Additionally, there were some questions about new businesses, whether new businesses qualify, and whether or not, if you've acquired an existing business, whether that qualifies. And so this is a very tricky, very fact and circumstance specific analysis for each business. But there is generally a credit available to what they refer to as recovery startup businesses. So these are businesses that were formed and only began operations after February 15th of 2020. They have average annual gross receipts of $1 million or less. They must have at least one employee that is not an owner. While if you acquire a business, depending on all the circumstances, if it's an existing entity, you typically are able to qualify because there are historic, there are historic financials that you can look at for a significant decline, or to use the 2019 numbers for the various calculations. I think that really concludes my segment here.
Thank you, Sarah.
Thank you.
Dave, do you want to go ahead?
Yes, thank you, Hal. So Craftsman Unity's experience has been kind of interesting. Initially, we thought that we did not qualify at all. We consulted some tax advisors, and based on the original rules of the quantitative rules based on revenue, we did not qualify. We qualified maybe in some locations, but not in other. Had some big drops in some locations, but we had some increases in others. So we did not qualify for the 50% drop in 2020 or in 21 against 20 revenues. And so we thought we didn't qualify at all based on this and based on some tax advisors' recommendations early on. As we got into this a little bit deeper though, we kept on getting more and more information. And as the rules evolved, we found out that we could qualify for certain parts of the FERC based on our experience and with shutdowns and government orders. we looked at 2020 first of all, and we a little bit reluctant to go into the pursuing that because we had used a fair amount of our wages during that year for our PPP forgiveness. And as Sarah mentioned, you are not allowed to double dip. And the credit is only $5,000 for the entire year for an employee. The other thing is our capital structure with going back and redoing our tax return could get very messy, having to refile tax returns, and that would flow down to our investors, which would cause a lot of returns to be amended. So the 2021 has been much more attractive to us for a few reasons. One, we haven't filed our tax returns yet. The other thing is that the scope was greatly expanded, and we qualify as a small business. We have about 165 employees currently, and the credit is much greater. We can claim up to $28,000 per year for per employee. Next slide, please. So, as I mentioned about the 2020, the only thing that was available to us was time or amounts paid for vacation, sick, furloughs for the periods that were not covered in the PPP program for us. This current credit, though, is considered a reduction in wages. And so, again, you have to file amended tax returns in some form, depending on your capital structure, to take advantage of that as the second part of getting the tax credit. Next slide, please. So we determined that in 2021, our eligibility period for the first quarter, we had the entire first quarter being eligible. And for that first quarter, our eligible wages came out to over $1.5 million with a credit amount of over $1 million. For Q2, because we only were available, or credits were only available because of the shutdown through June 15th, pretty much in most places that we do business in, the wages were down a little bit, almost 1.5 million, a credit of $1,033,000 for that second quarter. Next slide, please. So just to give you an example of maybe a typical search fund company of 40 employees with $40,000 of annual wages per employee, you might see Q1 eligible wages of $400,000, the credit of $280,000. Q2 based on Craftsman Unity's, or basic, depending on your location and government orders in place, maybe 2/3 were eligible. That would still give you a credit of $187,000. Q3, even if it's only half, you're still available credit would be $140,000. So for a typical search fund company, for 3 quarters, you might be able to recoup $607,000 of credits from the government. So it's definitely worth your time to look into this deeply, spend some time, and evaluate whether or not you can take advantage of these credits. One of the things that we found was that payroll providers basically had some reports available, so you don't really have to invent the wheel so much to do at least an initial examination of what your wages are and what is eligible for each quarter. And I think that is pretty much it in a nutshell. Al?
Great, thank you, Dave. Next slide, please, April. So, Sarah mentioned facts and circumstances. and what you heard from Sarah and Dave is that Craftsman Unity didn't qualify based on quantitative 50%, 20% revenue standards. We were not a small business in 2020, so we could only claim wages that for non-productive purposes like hero pay or sick pay or vacation. But in 21, we qualify for all our wages. And in 21, we still didn't qualify based on the revenue standards. So we have to qualify based on the qualitative effects, the government restrictions creating partial shutdowns. And that word partial shutdown, I think as you heard Sarah talking and she was going through the twists and turns of the IRS's FAQs, you get the flavor of how, oh my gosh, how foggy the IRS's answers are. They say partial shutdown, but it also applies to effects on your business. If you had more than just a short-term effect on your transition to working remotely, it's very complex. But here's what we read into it, and with the sort of congruence of all of the experts that we talked to. And this is sort of a legal, law school thing, and I don't remember if it came from Sarah or who, but when do you have a wall? When do you have, when you're talking about the Treasury Department and the IRS, is one brick a wall? No, one brick is just a brick. You put 5 bricks together, it's starting to look like a wall, and 10 to 20 bricks with mortar, now your individual effects from these government restrictions are beginning to build a wall. Okay, so this is why it took us really digging and really working on how were we affected? How did the different government restrictions and really understanding some of the things Sarah mentioned. For example, we have a division in Englewood, New Jersey. The governor of New Jersey imposed travel restrictions into and out of the state, which impacted our ability to manage that. It impacted our ability to operate there. Was it 10%? No, but it was a significant impact to our operations there. And that is one of our bricks. So it's not just does one restriction do it for you, does it, stop that division from operating? It is also, did you have a whole bunch of things that happened that affected your operations? Next slide, please, April. So part of what we're doing in preparation for a future audit, because if you're claiming, the whole enforcement is based on an IRS audit. So, we have created a 5-page internal document. Dave and I built this. We organized it based on the regulatory language. We split up the effects into those limiting commerce, i.e. the ability to conduct business in similar manner as it had been conducted in the past. Notice I'm using our language there, but it's within their structure. We have had changes caused within our suppliers by restrictions that have impacted our supply chain. And we've had changes to our production and business processes, big and small. We've had travel limited, or the ability of our employees to travel in the same manner as in the past. That changed our management practices, our training practices and processes. And we have been limited in our group meetings, the ability of our employees to participate in trade shows, meetings, and calls as they have in the past. And I'm not talking about phone calls, I'm talking about in-person group meetings. There's they specifically talk about this. So limits to our ability to visit customer locations, impact to our ability to attend trade shows, trainings, and conventions, impacts to our ability to participate in technical and innovation meetings. Next slide, please. So in our specific effects due to restrictions, so folks, I'm not going to go through all these for you, but in our supplier and supply chain, we had 5 identified government restrictions that impacted the supply chain, either directly to our suppliers or to us. Same thing in production, business process, and scheduling. We had 13 identified. Look, in Orange County, California, where we have an operation, the county health officials changed, they put in requirements under, the governor issued this blueprint for a safer economy. And then the health officials in Orange County, California, interpreted that, and they said, this is what you have to do in your business related to cleaning, to social distancing, to wearing masks, to having lunches in a indoor lunchroom, and et cetera, et cetera. So there were a bunch of things that these health officials' edicts, and they're basically proclamations, were just, trying to satisfy our customers' needs, trying to, maintain business and be in compliance, but significantly changing the way we do business. Limiting travel, 2 identified. I mentioned that New Jersey thing, limiting group meetings. By the way, in all these things, for example, since I mentioned that New Jersey thing, I want to say that that was eliminated on May 28th. Well, in the second quarter, we did not take the full quarter. I think we took, Dave, correct me if I'm wrong, up through June 15th, when the blueprint for a safer California ended. We didn't consider, there were just too many things that ended there in June. And so we did not take a credit for the full quarter. Long story short, folks, do 25 government restrictions which changed our business constitute a wall? Next slide, please, April. Yes. Together, these are non-negligible effects due to government restrictions, and we believe we're eligible. And so we've applied for all of Q1, part of Q2, and part of Q3, as there were some new restrictions that came on in mid-August in response to the Delta variant. And so anyway, that's our status at Craftsman Unity. Next slide, please, April. So there's a problem, right? Some of you are sitting there saying, wow, I've done a search, I can't find the executive orders. I can't find the proclamations, directives. We have Sarah working to conduct a legal database search, Wes, Lexus, et cetera, to find some of these old documents, because we don't have all of the documents. Here we are, Dave and I dove into this about 6 weeks ago. And at that point, even Gavin Newsom in California was undergoing a recall. Caitlyn Jenner and Larry Elder were trying to knock him off from the governorship, and the blueprint for a safer California, which was very contentious in these political circles, were down from the web. So as we dove into this, some of the things were already gone. How are we addressing that? Well, Sarah's helping us with that, 1. 2, we have collected news releases, news stories, press releases, et cetera, and have created our own set of contemporaneous notes, records, and memos that will be admissible in an audit. So, you may be sitting there and there's going to be a bunch of, I've seen the questions sort of scrolling up on the chat as they've been placed. We'll get to those in a minute in the Q&As. There's some great questions coming in. This is very complex stuff. We feel that we do have be enough documentation to where we can win in an audit. Okay, and that's our standard, right? It's that if there were an audit, we believe we're doing this because we believe we're right. We think we understand it, and we think we have the records to support it. Next slide, please, April. So there's a lot of options to pursue this, right? So we have greater than 100 employees. We're at 165. Our 2019 was as high as, I believe, 215 or 220, Dave. I forget your exact number there.
That's around the right number.
But if we had gone, there are groups, really good quality groups, no casting any aspersions whatsoever. We're doing a do it ourselves, right? Dave and I have spent a lot of hours on this. We've enlisted Sarah, and we've enlisted our tax people and our audit people at the accounting firms. Our accounting firms are all well known to you. Dave and I work with Boulay in Craftsman Unity. And so we've had them, the audit partner that works on us, involved in this, and their tax people as well. But we're doing a do it ourselves, because if we went with some of the other groups, do it on a contingency basis, well, you know, it'd be close to $500,000 at 15%. But say you have about 40 employees, maybe you do it yourself, depending on your staffing. Maybe you go with somebody like Synergy or Remus, or there's a couple other that Dave uncovered that work on these 15%. If you have 10 employees, my gosh, you know, hey, go contingency. Why? I'll tell you why. The contingency people, the work we've been doing on the justification, they will do that for you. That's the big thing that they add. The calculations with your 941s, your taxes, your payroll providers can do that. ADP or, you know, the other big payroll providers, they handle that stuff, and can file the 940, probably already file your 941s if you're a, you know, 20 employee company. But you know, the part that we've really worked on, that Dave and I have spent more time on, is the justification part. Okay, so if all that makes sense, by the way, we can get you a list of those people, can't we, Dave? You had somebody, you had 3 or 4 of them, right? That are suppliers on this subject, correct?
Yes. Yes.
Yeah. So anybody who wants that, you can email April, and we will give you that list of the sort of Synergy type people, of which many of you already know Synergy. I think David Dodson and David Carver and Rich Kelly and Jim Edmonds and the Search Fund Partners people have circulated. One of their portfolio companies used Synergy, and that's kind of how we got reintroduced to this after thinking we didn't qualify, as we saw an email about Synergy and followed up on it. Okay. Let's see, I think that's all I've got. Let's go to the questions. April, can you bring up the questions and we'll start diving into those?
Sure, I'll bring up the first question. Thank you for covering multiple locations. How does it apply to multiple divisions within a company? If one division was not affected, no impact to business, but another division was affected above the gross, above the gross receipt.
If you qualify, let me jump in and answer that, April.
Sure.
Can you bring that up on the screen so everybody can see it? Or maybe we need to do that ourselves. But if one division, here's something that's very, you know, great. It's a great answer on this one. So let's say you have 4 divisions, like Craftsman Unity has 5 main operating divisions. If one of them experienced a government shutdown, then this credit applies to all of them. So your full payroll. Hey, I want to say one other thing too on that, right? And that is, so if you're under 500 employees for 2021, this credit applies to productive wages for productive time as well as non-productive time. you're over 500 employees for 2021, excuse me, then it only applies to non-productive hours, like pay for time off in which, you know, you paid somebody but you didn't use them. So even a Walmart with 1 million employees, if they paid people to be off due to a government restriction and they kept them on the payroll, they can claim this credit, right? But if you are under 500 employees and you kept your people on and they were working at their regular job, the credit applies to their pay. That's the beauty of this thing. Ron Wyden, I'm an Oregonian, proud of Oregon here. Ron Wyden is primary author of this, and Ron Wyden has said multiple times, we want to help small businesses, and that definition was raised to 500 for 2021, keep their people employed. So, hey, it's a beautiful thing. Next question.
I'm just bringing these up in the chat. The next one is, when you say subject to a government order, do you mean our place of business shut down due to an order? Or do you mean in general there was a stay-at-home order more broadly for the state as a whole?
I'll go ahead and take that one. And so a government order, first of all, it has to relate to the suspension of your business. And so the IRS takes the position that something like a declaration of the state of emergency is not sufficient if it doesn't also limit, travel, commerce, and group meetings. So a general state of emergency or a general, suggestion to stay at home, that's not going to cut it. You do need something that says these businesses are the only ones allowed to, stay open, or all businesses must close, for, by 6 o'clock, and, your business maybe stayed open later, or, curfews. That's obviously going to be a big one. You also have this sort of line of IRS explanations relating to modified hours. So outside of curfews, if your business has to clean, every day, do proper closure or cleaning that requires a closure, that kind of order. But it cannot just be a general stay-at-home order.
Sarah, let's dive in a little bit. So let's say the state issues a stay-at-home order for all non-essential employees at an essential business. In other words, some portion of the employees are not essential.
Sure.
Like
right, like a hospital,
like accountants.
Well, I think a hospital is a great one to use. Hospitals were certainly essential, but elective surgeries were not deemed to be part of what is essential. And so, the stay-at-home order was, applicable to everyone that was not an essential business. Certainly, a hospital would have been subject to a partial shutdown because, part of its business was deemed to not be essential, and theoretically, it's probably a pretty significant source of their revenues.
Does that answer that question? I think so. There is some degree of, Sarah answers quite clearly that it has to be directly affecting you. But you have to say a general government order like the state of California saying all non-essential employees are to stay home. You have to measure that impact on your business, assess it, and say, yes, this affected us like that hospital that couldn't do elective surgeries.
So I think this question ties into not the following one, but the question underneath it relating to whether or not, so there was a simple, sorry, I'm reading this question. Okay, so the question is whether or not so a business would be considered to be partially shut down, even though they were not shut down because they were essential or something, but their customers were closed and their business requires them to physically access customer sites. So they're, going out and providing services, and whether or not that counts. As I mentioned earlier, a decreased demand from customers does not count, but the key takeaway here though is facts and circumstances, right? So if you're a bank, just focusing on the essential portion, if you just close because no one's coming in, that doesn't really count. But if your business fundamentally relies on going out and providing services and you're unable to provide those services because of this order closing your customers, we would have to look at the details. This is not an affirmative yes, but there's a very good chance that would qualify because you are not voluntarily suspending your operations as much as you actually cannot perform the services that make up your business.
To back you up on that, Sarah, one of the things that affected Craftsman Unity, and we did count as one of those business process changes, was the prohibition of group meetings stopped us from our normal sales calls, which involved our salespeople going into the customer's locations and going over designs, doing quotes, getting samples, providing samples, and it had a significant impact on our ability to operate. So we counted that as one of those bricks, even though it was a customer, not a supplier. Next question.
Sure. The next one is, we have 360 people and we're not shut down as we are essential. Supply chain disruptions caused huge price increases, which reduced our 2021 profit to zero. Our revenue did not decline in any quarter compared to 2019 or 2020. Is there a chance we qualify?
So, this again is the last portion of my presentation is where you have to sort of turn to look. Based on those, that information, it's impossible to know. You would have to determine, was there any part of your business that was shut down? If not a single portion of your business shut down, and you obviously don't have the significant decline in gross receipts, then you would not likely qualify. But if a portion of your business was shut down, again, facts and circumstances, it might be able to.
In other words, here we are. This requires that question is really interesting. See, we can't answer, like Sarah said, from what we've determined, just from those facts, but it's very possible. It is still possible, because it is, I'm assuming that if raw materials went up and your revenue went up, and your revenue stayed the same, that your volume of went down, and that there were actual supply chain issues that impacted your business due to government restrictions on your suppliers, it's very possible that there's a window that you can walk through on that, or a door that you can, maybe it's an overhead door, a 14-foot door, okay? But this is where you got to really dive in and determine if there were government orders that impacted your ability to do business. And so like your ability to get your raw materials was decreased significantly. I'm sorry to waffle like this, but this is the point of this. Don't just say the heck with it. Dive in, determine if you really do qualify. This is what Dave and Maya's experience that we want to share. When we started diving in and looking at all these myriad ways that it affected us, to me, it sounds like your business might very well qualify. Your 360 employees for 2021, if you were under 500 for 2019 is the actual standard, but you probably were. And so, you may well qualify. Don't know though. Sarah, fair enough? Okay.
Fair enough. Yep. You don't know what you don't know, but we just can't tell based on those facts.
Yeah. April, next question.
Yes. Is the credit per employee to be applied to all employees or only those who were not able to work?
So this relates back to the large versus a small employer distinction. If you are a large employer, it only applies to the wages you are paying to employees to stay at home, to not work. If you're a small employer, you can count all of the wages or any wages to employees. The 2020 definition versus 2021 definition of large employer is different. In 2021, a large employer is one that had on average more than 500 employees measured using 2019 full-time employees. During 2020, it's more than 100 full-time employees also measured on 2019 numbers.
So the answer is, if you're a small employer, it applies to everybody. That's the beauty of this. And that's why it's so meaningful to Craftsman Unity. In 2021, we, with our, under 500 employees, this and being subject to partial government shutdowns, this is amounting to $3 million. So extremely meaningful, especially considering that, the impact of the pandemic has been pretty devastating on our profitability.
I'd love to get to Mike's question before we run out of time. It says that, as I understand it, only essential businesses need to show a nominal impact. I think they mean more than nominal impact on their business. For non-essential businesses, it appears to be written in a binary way. If you were affected at all by a government order, you qualify regardless of the amount of impact. It seems that the IRS went out of their way not to define a specific amount for non-essential businesses. We've heard 3 different opinions from 3 different advisors. I think that is a very dangerous stance to take. I'll use the telework example. There are certain businesses that were not deemed to be essential. They were subject to stay-at-home or shutdown orders, but they have full capacity to work remotely. And in fact, before the shutdown, they often did. The IRS explicitly says that does not suffice. Even though they're subject to a shutdown order, they have the ability to work remotely. The work they do, take a lawyer. I can work from home. There's a laptop, internet, I can work from home. And my ability to perform my work is comparable to what it was pre-COVID. I think that that's going to be a hard one to sell as being eligible for the credit, unless, again, a portion of the business was affected. And so there are a lot of examples given by the IRS, but the one example they give is about some sort of consulting or research group. And some of the research physically has to be performed in the labs, but other research, and we're writing the reports can be done at home. And so you've got people that perform some of those tasks and others who don't. And basically, the lab portion was forced to shut down, even though people could still do comparable and a fairly significant amount of their work from home. But they were deemed to have a partial shutdown because of the lab portion. But if your entire business can work remotely and it's, there's no shutdown, I think that that's a hard one to sell.
Shall we keep going? There's a few more questions, or should we answer via email? I'm happy to keep going for another 5 minutes if you want to throw out a couple of questions, and if people need to drop, you're welcome to drop. It will be recorded. It is recorded. Want to hit a couple more questions there, April?
Sure. Let's see. For non-essential, what is a reasonable interpretation of a nominal impact? Absent of any clear guidance, is the 10% rule for non-essential reasonable to use?
Yes, I mean, I think 10%, well, if the portion of your business that is impacted represents either 10% or more of your business, the business's gross receipts, or the total number of service hours. I think that that's a very reasonable interpretation. I do know this is a topic of some debate. Some practitioners take a much more liberal stance. I am more conservative, and although I like to think balanced, but I do like, if the IRS puts it out there and says, they will consider, 10% or more to be not nominal, right? So that's the focus actually, is for it to have more than a nominal impact. Then I am someone who adheres to that. But there is a point where you have to make a decision for yourself and determine whether or not there was an overall impact that was more than nominal.
So I think it bears mentioning that the IRS, and most of you probably know this, but I'll say it again, the IRS has put out a couple of circulars on this. One's 100 pages, one's 20 or 30 pages, or 20, yeah. They're 2021-20 and 2021-23 that cover the ERC. And they have these various sort of safe harbors that the interpretation that we're following is pretty much Sarah's. When you hit 10% in terms of hours worked or revenue, it's clearly not, it is clearly significant. Try not to use double negatives there. However, we also have a number of impacts that don't reach the 10% threshold that we're still listing. We're still listing, if it applies to 4 employees out of our, say, 160 or 180. Why is that? Well, it may not be that is significant in and of itself, but when you got 10 that impact 4 employees, okay, now we're talking. So this is where there is a difference in opinions. Sarah, we glommed on to Sarah. She's sort of the middle ground You know, some practitioners will tell you every business in America can get this, and others will say if you don't have a specific 10%, then don't claim it. We've heard, you know, all blends between those two positions. We came down to this, that 10% is a great safe harbor. And we've got a number of others, though, that are not 10%, they're 2%ers. And we're listing them all in our internal documentations, because you don't give this to the IRS until and if and when you get an audit. So we're just trying to cover all our bases. Dave is maintaining, as our CFO, is maintaining, you know, a file of all of these impacts, and it's a thick file.
Yes, it is.
Any other questions?
Do we want to
There was
take one
one-
more?
Yeah, what about this one about using different government orders for different time periods? I like that one because I think that that's going to be applicable to most people. You're going to have to rely, like, piecemeal the different orders, whether it's at different levels of the government or among the states. And yes, that is definitely allowed. And even if it's in different time periods, that you just want to make sure that for any time that you're trying to claim the credit, you have a government order that, you know, impacted your business operations or suspended your business operations. You know, if there's like a 2-week period that there isn't an order that you were subject to, then you can't use the wages for that, you know, 2-week period.
Sarah, great point. So, you know, we have got in our files executive orders from President Biden all the way down to the Stanislaus County, California public health officer issuing a proclamation for businesses in Stanislaus County. And between there, we have CDC edicts, which are mainly go to these public health officials, and then they put them into effect for their locality, as well as OSHA, Cal OSHA. We've got the laws themselves. There were, we didn't really mention this, but you know, the original CARES Act was modified in late December, and then it was modified again in, I think it was June, wasn't it, Sarah, with another act of this year. So, you know, there's 3 separate laws governing this, as well as, you know, state governments, counties, the federal government, these different agencies. Yeah, you piecemeal it. That's what we've done. That's our 25 bricks. They're different agencies at different times in different locales. Any other questions you think we ought to hit, Sarah or April or Dave?
I think we've hit the big ones.
Good. Hey guys and gals out there in Zoom land, we hope this has been of use for you. You know, it's a very complex subject. Here's the punchline. You have to dig deep into your facts and circumstances. At Craftsman Unity, Dave and I have probably, I don't know, Dave, I don't even want to guess how many hours we've spent on this. It's been a lot. And but it's been worthwhile because it has such an impact on our business. This is a big one. A 40 employee company could very easily qualify for a $500,000 refundable cash tax credit. And that being the case, we think it's worth, you know, a lot more companies investigating it. And that's why, you know, in talking with MK and Sandro and Alex Stavros and Rush, Peter, the board of the Search Fund Alliance, Lacey Wismer's on that board, we thought, hey, our experience is worth sharing with the group. So, hey, we really appreciate all your times. If you have any further questions, please feel free to email April at the searchfundalliance.org or any of us, and we'll try our best to answer it. I feel like, you know,
Dave and I joke around a lot. Sometimes we become experts on things we have no intention of becoming experts on. I'm sure you
Yes,
all,
we do.
as small business people, have that similar experience. Anyway, thank you for your participation. We appreciate it. Have a good day.
Thank you, everyone. Bye-bye.
Thank you.